All right. Hi, everyone. This is Richard, and welcome to our next session. What it is today? Today is, day 14. Good heavens. Day 14 of our review. Now, of course, a lot of us couldn't be here tonight. Today is also a Columbus Day and, of course, Indigenous Peoples Day, so people may have had other plans. So it's kind of a small, intimate uh, session tonight. But it gives me a chance to provide, really personalized attention. So the question came up: was can we work through maybe a stock split practice question? Let's try this one. So I'm gonna type it out here while I do this, so that you'll be able to see it. Okay, and of course, if you're watching the recording, you're going to see what I type as I type it. Okay, so investor has 1,000 shares of XYZ Corporation, currently $5.50 per share. Okay, now just the fact that I said it was $5.50 a share might give you a clue as to what's coming up next, because that's a really low price per share. So what are they more likely to do, right? A reverse stock split. Okay, the company announces a let's see, 1-for-4 reverse stock split. What is the position after the split? Okay, I just hit enter. Oh, there it is. Okay. All right, so now it's a reverse stock split, right? A stock split is like cutting a pie into more slices, right? But a reverse stock split is like welding slice of pie back together. So you know just from that, you're going to end with fewer shares at a proportionally larger price per share. But the same formula works, right? Just as the same as we did it. Crunch the numbers again, and you'll get it. Okay, give me a moment too, because I just made numbers off the top of my head. So you'll tell me what you like. What do you think is the best answer? Okay, thanks, Alexis. I've got your response. Okay, thank you, Karina. Okay, Ashley, want to give it a go? All right, that's great. Okay, so the company announces a 1-for-4 reverse split, one share for every four that you have now. Now, right there, you can almost see it as a fraction. 1-for-4, one share for every four you have now is 1/4, right? 1/4 the number, but then each is four times the price, four times the value. But nevertheless, let's run it through our magic formula here. So to find the new number of shares, you take the original number of shares, which was 1,000 shares, multiply that by the first number in the ratio, which is a 1. So 1,000 times 1 is 1,000. Okay, and then divide the result by the second number. Okay, the second number is a 4, so 1,000 divided by 4 is 250. So that's our new number of shares, is 250 shares. All right, now the new price per share, so it started off at 5.5, $5.50 a share. Multiply that by the second number, which is a 4. 5.5 times 4 is 22. And take the result, divide by the first number, which is a 1. Okay, so 22 divided by 1 is 22. So our result is 250 shares at $22 per share. And that was it. You got it. So no matter what they throw at you, right? If you got the formula, you got the answer. Okay. All right. I have a feeling you're feeling a little more confident in handling stock splits. All right. Cool deal. Thanks, Ashley. And Karina. Okay. And celebration horns. Okay. Even better. All right, anything else that you'd like to go over? Anything else that comes to mind? Anything you saw during this last week that's still a little bit stuck? Dollars in and dollars out, which has me thinking that you're thinking about the T charts. Does that sound about right? Okay, about T charts. All right, so with T charts, we use these for options questions, and they'll actually help you answer questions like what is the maximum possible gain, maximum possible loss, break even where there's zero gain or loss, or win or lose scenario, profit or loss scenario. Okay, helps you stay focused, helps you keep from getting all lost in the weeds. Uh, but how can I do a T chart just in text like this? I probably can't. So if you'll give me a moment, I'm going to go pull up the actual slides, the actual slide deck, and use the T charts on there. So if you give me hang, I'm going to pause the video here. Okay, so I've just brought that up. Okay, so here's one of the T charts. You're able to see this okay, right? Okay. Oh, in fact, let me, I'm going to use my dual monitor. Hang on a second. All right, so here's our T chart. And we can use them for any option question. This one is going to be the long call strategy, where someone just buys a call option. Now, again, why does someone buy call options? A call option is a contract that gives someone a right, not an obligation, to buy 100 shares of a stock at a fixed price up until a certain date. Why does somebody want to pay money to buy call options to lock in their buy price now? Like it says here, right? They're bullish on the stock. They think it's going to go up later. That's why they want to lock in a buy price now. All right, so let's check this out. So a customer buys one ABC January 30 call at 4 when ABC is $29. Now, by the way, every time I see a question that says what the stock price was at the time they bought the option, every time it's just been an irrelevant detail, right? And they'll do that, right? They'll throw in irrelevant details there just as distractions. So that is just doesn't have anything to do with what's going to happen. ABC goes to 47 and the customer exercises the call. And what is and we have the chance to answer max gain, max loss, break even, or actual profit, win or lose scenario. All right, so let's check this out. So we're going to write down everything as we go. And since the first thing they did was to buy something, okay, we're going to make a mark of it. We're going to note it down on the money out column. We're going to buy the call, and we paid $4 a share for it. Okay, so I write down a buy call minus 4. Again, this is just me, but I like to make a little quick note about it because when I took my test and I just wrote down the price per share like it has you do in the textbook, sometimes I forgot what the number referred to. So now I make little notes about it. I put a minus sign in front of it to, again, make it more visually clear. All right, so what is the max? Okay, so now what happens here? ABC goes to 47 and the customer exercises the call. So we're going to say, well, what's max gain, max loss, and stuff like that. So first off, what's the maximum possible loss on this transaction? The worst that can happen, of course, is so our customer bought this call option, expected the stock to be above $30 a share, right? Because he's got the right to buy it at $30 up until January. If January comes and goes and ABC is still below $30, no one's going to exercise this call option. No one wants to buy something for $30 that's worth less than that, so they'll just let the call expire. Nothing else happens. Bought the call, that was it. Nothing else happened. So $4 went out on this side. Nothing came in. Actually, nothing else happened. So our grand total is minus $4 per share times 100 shares per contract, and that would be a minus $400. So that's our maximum loss, and I'll write that down here as minus 400. Now, what's the maximum gain on this transaction? Well, of course, what he does is his customers bought this option for $30, hoping that ABC is above $30 when it expires. Well, let's assume for example that it is. So let's go ahead and say we're going to exercise our call out because it says the customer exercised the call, which means they use their right to buy 100 shares of ABC at $30. So let's go ahead and buy ABC for $30. All right, now at this point so far, how much did the customer spend? How much is our customer out of pocket right now? Let me get rid of this here. How much is the customer out of pocket? Between these two things, he spent a total of $34. Yeah, exactly, Alexis. Good. Ashley, Karina, got it. Good. Perfect. So, knowing that he just bought ABC stock, figures sooner or later he's going to sell ABC stock. So what price is he going to sell ABC stock for just to break even? If $30 went out, how much got to come in? 34. Exactly, Karina, you got it. Okay, so if 34 went out, so a total of 34 went out and a total of 34 came in for a grand total bottom line of 0. And that's their break even. So at break even at that $34 a share. So remember, he has a right to buy it at $30, but had to spend $4 a share just for the privilege of locking the price. And before you can show a profit, you got to cover all your expenses. That would include the premium paid for the option. So once it goes above $34, he's going to start to make money, right? Then this trade is profitable. Now, the higher it goes, the more money he makes, right? Right? Go 35, 36, 37, keeps going up and up. Now, what's the maximum? What's the highest price a stock can possibly go to? Is there a limit or ceiling how high it can go? Right, Alexis. Yes, unlimited, at least potentially, right? So there's no limits how so it can go as up on an unlimited amount. So now, if 34 went out and infinity comes in, well, what's their grand total? Okay, exactly right. No limit, right? Infinity, right? Total is plus unlimited. All right, so our maximum is, again, theoretically unlimited. Okay, now that's going to be the answer for the test question. I know in real life it's not going to go to infinity, okay, but there's nothing stopping it from doing so, right? There's not an actual cap or ceiling on it. That's just reality. But nevertheless, that's the answer for the question. All right, now let's take our profit and loss scenario. So we're here so far. So the customer exercised the call, right? It went to $47. Exercised the call and bought it for $30. Now the test question will usually say that the customer then sold ABC stock at the current market price, which is of course 47. Oops, 47. So now 34 went out. Let me write this out. Okay, 34 went out and 47 came in. So how much is he up at this point? Yeah, there you go, Alexis. Right. Plus 13 times 100 shares per contract equals plus $1,300. Okay, so we just did it, didn't we? We went through all the possible scenarios we could do here and filled in our blanks using these charts here to help us stay focused. Okay, big celebration. I'm going to change this a little bit though. See, so many of these practice questions have you trading just, has someone trading just one contract at a time. What if it was two contracts? Okay, what if it was two contracts? Now, this is again personal preference. Some people like to do them in totals. I prefer to write down price per share, and then I multiply by 100 shares per contract, and then multiply by the number of contracts. That's just me. I find it works out easier that way. So what's the channel? Now the break-even point will stay the same. Maximum gain is still unlimited. Okay, it's still infinity. What's the maximum possible loss now? Is it still 400? Ah, there you go. I think you're right, Alexis. Because the maximum possible loss, which would happen, of course, if the option expires worthless, as always for an option buyer, maximum loss is the premium paid. Can't lose more than what you paid for the option. So $4 per share, losing $4 a share, times 100 shares per contract, times 2 contracts. And therefore that would be minus $800. Excellent. Okay, now how about this? ABC goes to $47. The customer exercises the call and sells the call at the market price. What's the profit or loss scenario now? Is it still 1,300? Okay. All right. Rather than me fill it out, I'll let you fill it out for a bit here. I'll let you use your scratch paper. Right, they give you a dry erase board at the test center, so use it. So can anyone tell me what is the capital gain or loss on this transaction with 2 contracts instead of 1? Well, everyone said 2,600. Let's figure it out here. So first off, we're going to exercise the call. All right, we're going to buy ABC at $30 a share, and then we can turn around and sell ABC. Again, this is just me doing this, but you know this that I kind of do things like line by line from top to bottom to show where the order, right, and the orders in which things took place. Again, textbooks don't do that. That's just me. It just makes it more visually clear. So we're going to sell ABC at the market price of $47. Well, if 34 went out and 47 came in per share, we're up by $13 per share times 100 shares per contract times 2 contracts is plus 2,600. Brilliant. Have you sussed it all out? Hey, all right, celebrations. Okay. Tell you what though, I'm going to go on a little lower here. I'm going to scroll down for a bit and see if I can find one that maybe is just a little more challenging here. Okay, we're going to do this as a hedging strategy. Now the textbook here goes options on one side, but I prefer money out and money in. All right, the columns are called debit register and credit register respectively. And if you took any basic accounting, that might sound familiar, but we're not here to become accountants. We're here to pass a test. Let's make it as easy ourselves as we can. A customer buys 100 ABC at 50 and buys one ABC January 50 put at 5. ABC goes to 36 and the customer exercises the puts. What's the max gain, max loss, break even, and profit or loss scenario? All right, so help me fill out the chart. So the first thing they did was buy something. We're going to buy, let's try that again. We're going to buy ABC for 50. The next thing was to buy the put option. Buy put for 5. Oops, 5. First off, can you tell me what is the purpose of this strategy? Why does someone buy the stock and then buy a put option? I mean, buying a stock must be bullish on the stock, right? But buying put options is bearish, isn't it? So what is this? Is he bullish? Is he bearish? Is he just confused? Alexa says to protect against the drop in stock. How can it protect against the stock? How can it help them protect against a loss here? Tell me how. By a hedge, right? Okay. Alexa says if it goes lower than the strike price, they can sell it at the higher strike price because buying a put option is a contract that gives the investor the right to sell 100 shares of stock at the strike price at a fixed pre-agreed price, no matter what the actual price is. So that means he can get out of his investment at the strike price and knows his worst case scenario. That's brilliant, Alexis. Great job. So let's check this out. First off, bought the stock for $50 and then bought the put for $5. How much money has he spent so far? How much are we out of pocket right now? $55 out of pocket. Right, exactly. So therefore, having bought the stock, I'm sure eventually wants to sell the stock. What price you got to sell it for? Just to break even. That's kind of self-explanatory, isn't it? All right. Yes, exactly. You got to sell it for $30, $55. Because if that happened, then right, a total of 55 went out. A total of 55 came in for a grand total of 0. All right. So notice this, right? So bought the stock for 50, but it's got to go up 5 points. ABC's got to climb 5 points before he can break even, before he can show a profit on it. So that is going to eat into his profits. And if it goes right, it's got to go above $55 just to break even. Right? Because he hadn't bought the put option and went to 55, he'd made $5 a share. But no, he's got to cover that cost first, right? But that's the cost of insurance, and that's just the price you pay, right? And that's the cost of protection. And investors are going to say they're okay with that. They give up some of the upside, but it protects against the downside. So let's take a look. So that's our break-even point now is 55. Okay, maximum possible loss in this scenario. What's the worst? Okay, or actually, before we do that, let's go maximum gain or maximum loss. Let's go maximum gain first. All right, bought the stock for 50, paid $5. So the break-even point is 55. Once it goes above $55, he's going to show a profit. What's the maximum gain in this scenario? Unlimited. Right, because it can still conceivably, anyway, go to infinity. In which we still have the scenario where 55 went out and infinity comes in, and therefore maximum possible gain is still conceivably unlimited. Okay, now what's the maximum possible loss in this scenario? What's the worst thing that could possibly happen? And the worst thing that could possibly happen is ABC is bankrupt, out of business, stock is worthless. So does that mean he just lost all his investment, that he lost all his money? As he just lost $55 a share. Minus 5,000, 5,500, maximum loss is, it's not. That's not the maximum loss. And how come? Because he bought a put option with a January 50 strike price. Bought the January 50 put, which gives him the right to do what? Oh, see, Alexis, yeah, okay, I think you worked it out. Oh, wait a second. Sorry, that was a 5, that was a 55. I thought that made a dollar sign. 5. Okay, so let's check this out then. He's got the right to do what? Sell at 36? No. He could, of course, but hey, he doesn't have to, does he? Why not? Bought the ABC January 50 put and has the right to do what? Right to exercise. And if he exercises, what does that give him the right to do? No, not to buy at 36. He already bought, right? Already bought it. Doesn't need to buy it again. A put option is a contract that gives you the right to put it to somebody else, right? So is that buy or sell? Sell. At what price? at the strike price. And how much is the strike price? No, $5 is the premium. That's what the investor paid for the privilege of locking in the price. No, he doesn't have to sell at $5. He paid $5 for the option. He can sell the stock at, oh, you had the wrong, it would be 50. Yes, the January 50 put option. So up until the third Friday in January, he's got the right to sell ABC stock at $50 a share. And if that stock crashes, well, there should be a plus sign. Because if that stock crashes out, he can still get out of it at 50. So what's our worst case scenario? 55 went out and 50 came in, making a grand total of minus $5 a share times 100 shares equals minus 500. Which, of course, if the stock did go to $36, hey, if the stock went down to 36 and you got to get out of jail, well, actually, I had to pay for it, but still, a get out of jail free card for $50. Now, again, that's like disaster insurance. He's going to use his insurance policy. Okay. Okay. All right, Karina, there's a face and it's like a cloud there or something. Okay. Is this making sense, or is this still a little vague? A little not quite there yet. If you're not totally sure, this would be a great time to ask. Thank you, Ashley. Having trouble sometimes stating what the question is stating. Right now, this particular question says ABC goes to 36 and the customer exercises the put. Well, by exercising the put, he uses his right to sell ABC stock at $50 a share. Now, and again, having done so, even if the market goes to $36, he can still exercise his put and get out of it at $36. That's minus 500. So again, by doing so, that's the worst case scenario. You can still get out of it at $50 a share. Okay. So this particular question, now note when you see the structure like this, the customer buys ABC stock, someone has a position in the stock and then buys or is long an option to go with it. The reason they get the option is disaster insurance. All right. Remember, they always buy the option. The option that they buy is the opposite of what they want to have happen. They buy the ABC stock, they must be bullish on the stock. Why do they buy a bearish option? Well, because it's the opposite strategy in case the opposite of what they want to have happen does happen, right? Okay, they want it to go up, but it doesn't always go according to plan. So they also buy disaster insurance. In fact, let me put it this way: what do you call the price you pay for an option? So when it says the put was $5, what do you call that? Premium, right, Karina? Exactly. What do you call the price you pay for insurance? When you write a check to the insurance, that's called a premium. That's not a coincidence. Terminology from the insurance industry, like premium and contract writer, right, also show up in options. Okay, that's exactly the reason, because that's why options were developed as a way to protect investments. Now, if someone takes a risk, the person who buys the option takes the risk. I should say the person who sells the option in exchange for money is also taking a certain risk. Okay, but the person in this case, the person's buying the option, okay, because they're trying to alleviate their risk, trying to reduce their risk by buying insurance. Okay. All right, are we good? Is this all right? Okay. So again, if you just write them down line by line, step by step, and when you see this kind of setup here, has a position of stock and then buys an option to go with it, that indicates a hedging strategy. And the reason they do, right, for protection. All right, let me go ahead and put this on hold and let's bring up a Kahoot. Ready to go. Okay, our game pin is 2349646. Oh, you can't see the screen. Oh, well, that would make sense, wouldn't it? Might help a little bit, doesn't it? Keep me honest with you, okay? All right. What's this? Right here. And actually, all right. I think all three of us are here. Are we ready? Let's play. Family. Hey, you're guaranteed a place on the podium, Mark. All right, let's begin. Thanks a lot. Okay, first question. A corporation sells to the investing public in order to raise capital. This is known as A, a secondary market transaction, B, a primary or investor-investor transaction, C, an exchange market execution, or D, an issuer transaction. Oh, goodness, everyone answered, but no, the real answer is an issuer transaction because who's selling the shares? The corporation. That's the one who issues the shares, all right, creates and sells shares to sell to the public. So it's an issuer transaction. Now, here's the thing. See, it is a primary market transaction. Selling new shares from the issuer to investors is primary market. But the explanation here, the answer choice said primary or investor to investor. See, investor to investor is not primary, it's secondary. So this was really a contradiction in terms. Okay? Secondary market refers to trading between investors, right, of securities that have already been issued. Okay, so that's the issuer is not involved in a secondary market transaction. Okay, if there's any part of that, if you still need some detail about that, please feel free to ask. Okay. Okay. Next question. Which of the following be allowed during the cooling off period? A. Distributed prospectus. Take orders. Or B. Allocated shares. You're answering quick. Okay. What is allowed? Yes, taking indications of interest. That cooling off period, this is that period of time, minimum 20 days, right, when the issuer, right, when they file their registration, they have their filing date, and the time where it's finally cleared by the SEC, right, when it's cleared for sale, the effective date. They cannot sell these shares. They cannot offer them for sale, advertise them for sale, but they can take indications of interest, test the waters, find out who might be interested. They cannot deliver the prospectus yet, at least not the final prospectus. Now, had the question said distributed a preliminary prospectus, that might have made sense. Right? They can give the preliminary prospectus so that any potential can decide whether they want to give an indication of interest for or against. But it said prospectus, that would mean a final prospectus. I have to say specifically preliminary. Okay, let's see how we did. Okay, Alexis is out in front. Let's try the next one. Which of the following securities is exempt from the Securities Act of 1933? A. Common stock. B. Preferred stock. Yeah, everyone got this one. Municipal note, right? Because as municipal means, right, state and local governments. Anything that's government issued is automatically exempt from registration. The purpose of registration is, well, to protect investors from fraud, so they have to know who's out there. We already know who the government is. So municipalities are exempt. All the others are corporate securities. They don't get any exemptions. Okay, everyone's on the board. Let's check our next question. Restricted person is not allowed to purchase an IPO of common stock. All the following persons are restricted except A. Registered representative. B. Broker dealers. C. The grandparent of a restricted person. D. Any other person owning 10% or more of the firm. Hey, you nailed it, right. Because, right, first off, not you, right? Registered representatives, that's you or will be soon. Okay, right? Because it's an IPO, initial public offering. It's got to be to the public, not to the industry. So reg reps, broker dealers, someone who owns 10% of a member firm, right? That's basically an executive of a firm. But okay, and neither can immediate family. But grandparents are not considered immediate family. They did great. Ashley's 3 in a row. Pretty impressive. Let's check our next one. Regarding primary offerings, which of the following is true? A. Corporations can have two primary offerings, the IPO and APO. B. There is no limit to the number of primary offerings a corporation can have. C. Corporations can only have one primary offering, the initial public offering. D. After the initial public offering, a corporation can only have one more. Okay, some difference of opinion here, but yes, there is no limit to the number of primary offerings. There can only be one initial public offering. There's only one first time, but there can be any number of additional public offerings after that. Choice A, I'm going to say that the red one was a little vague to me because there are two types of, you say there is an IPO and an APO as being two types, but I think they meant that they can only do it twice is what they really meant by that. So that was a little vague, but choice B is a better description. Keep in mind, we're always looking for the best out of 4. Karina's 3 in a row and moves up some points. Nice. Which of the following would most closely match the meaning of a red herring? A. A tombstone advertisement. B. A registration statement. C. A prospectus. Or D. A preliminary prospectus. Awesome. Yes. A red herring is a preliminary prospectus, which is given out during the cooling off period to help people decide if they might want to put in an indication of interest or not. Right. And it's known as a red herring prospectus because it says in red ink on the cover that this is not an offer for securities. The registration is not affected with the SEC, and this preliminary prospectus will be replaced with a final prospectus. Good. Karina's 4 in a row. Nice. Let's try the next one. When issuing additional bonds to the general public in order to raise more capital, a corporate issuer is engaging in A. An initial public offering. B. A primary offering. C. A secondary offering. Or D. A private securities. Exactly, it is a primary offering, right? Because a primary offering, right, is done in primary market from the issuer to ground floor investors. Now, it was not an initial public offering because it says when issuing additional bonds to the general public. We got to watch out for that, right? Sometimes one word will make the difference. It couldn't, if it was an additional offering, it couldn't be an initial public offering, but it would still be primary. Good. Okay, Alexis and Ashley move up. Let's check our next one. The aftermarket prospectus requirement following an APO for exchange-listed securities is A. 0 days, B. 25 days, C. 40 days, or D. 90 days. No, this was a hard one. There's no doubt. Okay. Basically, this: how after an offering, how much time after that is a prospectus required? And part of the answer is the security exchange listed, right? And that includes NASDAQ, by the way, or is it an unlisted security? They figure that unlisted securities, if not on exchange, information is harder to come by. So the requirement for a prospectus after that is a longer period than it is for exchange listed. For an additional public offering, in other words, it's already gone public, right? They've already had their IPO. Information for an exchange listed security should be fairly easy to come by, right? It's all in a it's in a database, right? It's all in the Edgar database. So there's actually no aftermarket prospectus requirement for an additional public offering. Okay, tricky question, I know. That was a difficult one. A tombstone advertisement placed before the effective date can A. Be placed by the issuer directly or by the B. Only be placed by the assistant of the company and the underwriter. C. Only be placed by the issuer. D. Only be placed by the All right, yes, can be placed by the issuer directly or by the underwriters. Anybody who's involved can place the ad. Okay, no, it's not only by the issuing company. Again, this was a kind of a difficult question here. It's a little fine detail here. Choice D, of course, nobody chose that, but because a tombstone is not an offer to sell securities. In fact, if you ever see a tombstone ad, it says right on it, this is not an offer for securities. It's an offer to acquire a prospectus. Next one. Assets offered and traded in the securities market can include all the following except A. Currencies, B. Equities, C. Derivative products, D. Life insurance. Hey, good shot, okay? Life insurance is not a security. It's a contract, okay? It's a contract with a life insurance company who has to deliver on the contract if, in case in case the insured passes away. Just to keep in mind, though, if it said variable life insurance or variable annuity, if it's got the word variable in it, it's both insurance and investments. So variable insurance is considered to be a security. Right? They're basically mutual funds. All right, everyone's got some points. Let's check our next one. In a split offering, A, all shares are issued to the public. Shares are issued to existing shareholders only. B, shares are sold. B, shares are issued to the public and sold by Awesome, yes. Even just to tell you, it's a split offering. Something's got to get split up somewhere. So all the other three were from one source only, but choice D, issued from the corporation and by existing shareholders. And that's quite common, by the way, because like the venture capitalists who put the seed capital into the company, right? Their whole exit plan was to take the company public, and once they did, they sell their shares in the public market. All right, did great, and everyone's got some more points. Pretty close between Alexis and Ashley. Not too bad. Let's check our next one. All the following names describe the Securities Act of 1933 except A. The Truth in Securities Act, B. The Full and Fair Disclosure Act, C. The Exchange Act, or D. The Prospectus Act. The natural name, right? The Securities Act is also called Truth in Securities because that's the purpose of it. It's called the Prospectus Act because it requires the issuance of a prospectus. And the prospectus gives full and fair disclosure of all material facts to potential investors. The Exchange Act, that's short for the Securities Exchange Act of 1934. Now, by the way, there's another nickname for the Securities Act of 1933. Can anyone tell me what that is? Another name for the Securities Act of 1933. Totally give you bonus points for this one. No, a thumbs down, Ashley, okay. Anyone else? Okay. Another word for the Securities Act of 1933 is called the Paper Act. They call it the Paper Act because it requires securities, which is a piece of paper that says you've got an investment interest in something, has to be registered with the SEC. Another name for the Securities Exchange Act of 34 is called the People Act because this says the people in the industry, right? Broker-dealer firms, their employees, the stock exchanges also have to register with the SEC. Next question. Securities regulations that are called blue sky laws refer to those at A, both the state and federal level, B, the state level, D, the federal level. Excellent. Yes, it's the state level, right? State securities laws are known as blue sky laws. All states have their own securities laws. So they call them blue sky laws. The name comes from a judge's decision. I think it was like 1919 or maybe it was like 1911, where the judge says people are being sold these investments that were worth only so many feet of blue sky. People are being sold these worthless investments is what it is. So there were states laws. States had acquired securities laws before there were federal laws, before the Securities Act of 1933. Good. Okay, good. Now, what is the act, the regulation that is like the model law, the template law for state securities laws? Can anyone remember that one? What is the name for the model or template for state securities laws? All right, no problem. Okay, the Uniform Securities Act. Okay. Yeah, Uniform Securities Act of 1954, because that was the basically attempt to make all the states have kind of like similar securities laws. Because after all, I mean, well, at the time there were 48 states, but now there are 50. All right, but they all say different things, and that can get confusing sometimes. So the idea was to try and make them more standardized. Okay, how are we doing here? Okay, great. Let's check our next one. Which of the following could not be considered an institutional investor? A, QIB, B, bank, C, an accredited investor, or D, insurance company. Okay, all right, some difference of opinion here. Not an institutional investor. An institutional investor means a financial institution, one that's in the business of handling money. So a QIB, qualified institutional buyer, a bank, right, handles money. Insurance companies handle money too, right? But always has to be a business, has to be a firm. And a credit investor is always an individual, never an institution, not a business or a corporation. Always an individual is just someone who meets certain financial conditions. Okay, Karina moves up there. Nice. Okay. All right, what's our next one here? A preliminary prospectus is used to solicit A, indications of interest before the registration filing. B, sales before the effective date. C, indications of interest before the or D, sales after the effective date. Great job, right. For indications of interest before the effective date. Remember, that's the cooling off period between the filing date and the effective date. And that's what they use to get indications of interest. Now, preliminary means it's going to leave out some information. It leaves out, of course, the effective date because it's not effective with the SEC yet. And it won't have a final price yet. It's only going to have a price range at this point, somewhere between here and there. That based on the indications of interest that they get, they'll use that to determine whether the final price will be at the lower end or higher end of that range. Okay, sales cannot be before the effective date, right? Because it's not effective with the SEC yet. You're not allowed to sell it, offer for sale, advertise it as being for sale before it's effective with the SEC. Just get indications of interest. I believe that was our last one. Let's see. Okay, in third place, bronze medal. Actually, in second place, silver medal. Yeah. And in first place, gold medal and Olympic champion, Alexa. All right, awesome job. Great. Okay. All right, so that was really good. Who's here? So no one's asked any other questions about that. But for right now, we're right at the top of the hour. So let's go ahead and take a quick little break here and return at 12 past the hour. Okay, now whatever that hour, okay. And if during our break, as always, if you'd like to ask a question or if you'd like me to open up a previous slide or anything else, please feel free to type it into the chat or unmute and ask your question, and I'll reply to you accordingly. All right, on that, I'll see you in just a few minutes. All right, welcome back from break, and let's go ahead and close this one out right now. Okay, all right, so remember last week we finished up by talking about the FINRA rules, okay, about the the regulations from the Financial Industry Regulatory Authority. But now we want to pay a little closer attention to the MSRB rules. So the MSRB is the Municipal Securities Rulemaking Board, and it's the major self-regulatory organization that oversees the municipal bond industry. So sometimes the rules are a little bit different between them. Okay, so the SEC, again, the SEC, remember, is a federal agency. It's actually part of the government, writes and enforces its rules, okay, and basically everyone and everything in the industry, right, reports to the SEC. That includes the self-regulatory organizations, FINRA, MSRB, and okay, all these things are with the SIC. But the idea of the SIC was a federal body, a federal agency which had force of law and can oversee the entire securities industry. Now, originally, they figured that the securities industry, especially the over-the-counter market, was too decentralized, right? Too all over the place to be able to actually effectively oversee and regulate. They just thought it was too there. So the industry says, we'll step up. We will basically oversee ourselves. We'll police ourselves so the government doesn't actually have to do it for them. So an amendment to the Securities Exchange Act of 1934 allowed the creation and oversight of self-regulatory organizations, or SROs. So it basically says that to be in the industry, most firms will have to actually be members of the self-regulatory organization, and as members have to pay their dues of membership and have to agree to abide by the rules as set forth by the SRO. Now, one thing about the self-regulatory organizations, they can create rules, but they are not laws. Okay, so they're not like impact of laws. They don't have that legal impact of it, right? The SEC can enforce laws. Well, they can certainly investigate. Now, oh, by the way, keep in mind that the SEC can investigate, right? And there are complaints. They can investigate rules, but they cannot. They cannot. They cannot arrest anybody. They have no power of prosecution. Right. If there's a criminal action, they can refer evidence to the Justice Department, and the Justice Department can take legal action. Yeah, they can prosecute. Okay. So other things that FINRA does includes, well, registering representative, right? That's what this whole test is to become a registered representative, someone who represents a broker-dealer firm and is registered with FINRA. Also, as mentions here, creates the qualification exams. This whole test that we're placing here is FINRA's exam. Sets up the continuing education requirements to maintain your registrations, and interprets rules again originally for the over-the-counter markets, right? Because the over-the-counter is the decentralized, the dealer market. Now remember, the stock exchanges also, the New York Stock Exchange, Boston Stock Exchange, American Stock Exchange, they're also self-regulatory organizations as well, right? They also regulate its members. Now the MSRB, as you notice, can create rules about the municipal bond industry, but does not have the ability to enforce its rules. It does not have enforcement capability or authority. Instead, the MSRB relies on someone else, mainly FINRA, but can be the SEC also, right, to oversee its rules. Now, if it's coming with working with banks, then they're going to work with things like they'll get the FDIC to enforce its rules, or the comptroller of the currency to enforce the rules, but it has no enforcement authority. The MSRB also creates qualifying exams, right, ones that are specific towards municipal bonds, and the rules for municipal markets. Okay. Now, keep in mind, they do not have any authority over the municipal governments themselves, right, over state or local governments. They have authority over companies that sell municipal products, that consult with municipalities, that offer services, that help them do offers and regulations, and create municipal products, but not the municipalities themselves. So as it says, they create regulations for, as they say, banks, broker-dealers, municipal advisors, anything that's involved in municipal bonds, but not the actual municipalities themselves. As I said, they don't enforce their own rules. They rely on the SEC and FINRA for broker-dealers, and the Federal Reserve, the FDIC, and the comptroller of the currency to handle, banking. Now, there is a special registration for people who just specialize in municipal bonds, right, in municipalities. They have to pass the SIE plus a Series 52. Right? I doubt you're going to have to remember that for the test, so I don't worry about that too much. And also having continuing education requirements, right, the same requirements that FINRA has, which now, just this year, is an annual continuing requirement education. Used to be every 3 years, now it's every year. Also, the same rules that FINRA has. Now, this doesn't apply to anybody here, obviously, but the rule is if someone doesn't fail, if they don't pass their test on the first or second try, they have to wait 30 days to retake. But if they don't pass on their third try, they have to wait 180 days. That's about 6 months, right, to retake the test. All right. The question is it just you? Oh, wait a second. You can't see the screen. Oh, I'm sorry. You got to keep me. I know. Keep me honest on these things. I forget to hit the share screen. Okay, hold on here. All right. A little better, I assume, right? So let me just go back here real quick. This will be in the recording, of course. But the MSRB, as you see here, right, has the authority to create rules for the municipal bond industry, but does not have authority to enforce its rules. So it relies on others. It relies on the SEC and FINRA, right, for enforcement with broker-dealers, and for banks, the Federal Reserve, the FDIC, and the comptroller of the currency. Okay, so again, they have much of the same rules, except that they have to pass the Series 52. Now, again, the Series 7 also allows for to someone to take orders or sell, buy or sell orders on municipal bond products because the MSRB does recognize the Series 7 as being capable of doing so. Now, just like FINRA says, you have to have a copy of the FINRA manual at every branch office available for customer inspection. Well, the copy of the MSRB manual has to be there too, available for customer inspection. Now, also, by the way, access equals, as long as they can access it, access equals delivery is FINRA's and the MSRB's understanding. So if they can access the FINRA manual or the MSRB manual from the website, and by the way, if you ever want to check it out, you can always check them out here at msrb.org. Okay, so you can find out more information about it, but nothing on there that you won't need that you won't get from the actual test from your own textbooks. Okay, now here's some things about conduct code with customer accounts. Now we know that municipal bonds are, federal tax exempt. That's the big advantage, but the big drawback is they have a much lower interest rate. And for most people, the tax savings is not enough to justify, not unless their tax bracket is so high that it makes sense now. Well, that's why they want us to get, information about customers, right? Always know your customer to know that any recommendation is suitable to the person you recommend it to. Now, we're going to ask for people's financial status, like income and net worth, and what tax bracket they fall into. But they don't have to give it to us. All right. I mean, it's not helpful to us to help us make recommendations, but they don't have to. But if they don't want to, but if we don't provide this information, then we've got no basis to know if a recommendation is suitable or not. We just can't tell. So we cannot make recommendations for municipal bonds if we don't have this information. However, if a customer calls and says, I want to buy this municipal bond, well, then, of course, then they couldn't accept an unsolicited offer. Unsolicited means the customer calls and says, this is what I want to trade. Okay, if the customer picks up the phone first, then we can accept the order. Now, by the way, sometimes a question comes up is, what if you do have information about your customer and they want to place a trade that you know is unsuitable to them? What do? Do you say, no, you can't do this? Do you say, you sure about this? Do you take the order anyway and not say anything? Regulators say you should have a conversation. Okay. Yeah, you should have the conversation first, right? So you should ask them what makes this interest to you, right? Make sure that they're not working under some misconception. But like Karina says, if ultimately they insist and they say this is what they want to do, you're right, Karina, right? Follow customer instructions. Exactly. Check the box on the order ticket that said it was unsolicited to make it clear to your compliance department that that they called and said this is what I want to trade. All right. Control relationships, right? A control relationship is something that can create a conflict of interest. So if the broker-dealer rep is also associated with the issuer, meaning that municipality, it has to be disclosed before entering the trade. Now, what kind of association could somebody have? Well, for example, they might, remember, firms try to be involved in the writing, the offering of municipal bond offerings, right? To get that contract to do the municipal bond offering, to do the underwriting, which can be a pretty lucrative contract sometimes. So if they're associated, yes, it just must be written disclosure must accompany the confirmation. The confirmation, remember, is basically it's their receipt of the trade, and it's a one-sheet document that's got all the details of the transaction. All right, annually, every year, just like there's some rules that FINRA has, every year customers be updated a statement that a broker-dealer is registered with the SEC and MSRB. And by the way, they just say member or registered with the MSRB, not approved by, not endorsed by, not given authorization by, anything like that. Just member of. Notice always very neutral language. Include the website for msrb.org and that they can download an investor brochure, which describes that if they have a complaint, right, how to file a complaint with FINRA. Why file with FINRA? Because remember, the MSRB doesn't have enforcement authority. They rely on FINRA to do the actual enforcement for it. Okay. All right. Any information received in a fiduciary capacity cannot be used to solicit to purchases or sales except with the consent of the customer. As a fiduciary must always put their customers or beneficiaries' interest ahead of their own at all times. So as an investment advisor acts in a fiduciary capacity, which also means there's a certain level of confidentiality that's expected as well. So should you receive customers as a fiduciary, you can't turn around and say, hey, this is, you can't try and use it to sell somebody else about that information unless they say it's all right. Now, customer complaint, remember, a customer complaint must always be in writing. Okay, calling you up and chewing you out. And look, I worked in the call center for 8.5 years. I've got plenty of calls where I got chewed out. But that is not a complaint according to regulators, right? Regulators say that it must be in writing, although email counts. The customer also must receive the MSR, the investor brochure, and a written complaint must be kept on file for 6 years. Now, see, with FINRA rules, right, they say 4 years. MSRB, if it's about a municipal bond transaction, that has to be kept on file for 6 years. And the principal, right, the supervisor, must sign off on it as well. All right, as always, of course, one thing that regulators want to see is a fair and reasonable price, fair trading practices, right? Open and equitable markets. Okay, so one thing, of course, is that the price of a security. Now, remember, the municipal bonds are sold in a dealer market, right? In the over-the-counter market. It's not an exchange. It's not an auction market. It's a dealer market. So the price is set by dealers. Dealers say this is the price I'll buy it for and the price I'll sell it for. And so the price must be fair and reasonable based on current market conditions. And the dealer quotes has to be a dealer's, based on their judgment about the value. Now, what type of things go into that value? Well, there can be all kinds of things about it, including the inventory, how many shares are available, how many bonds are even available. Now, the thing about municipal bonds is it tends to be a very thinly traded market. While there's lots of activities of municipal bonds overall, but the activity for a single municipal bond might be kind of hard to come by sometimes, right? How much trading is there, for example, for a City of Yuma School District bond, right? So they may be offering them and selling them, but if you wanted to buy one or sell one, it might be hard to figure out to match that up, buy or sell. So we have to include what the inventory is and how likely it is that they can basically resell it. If a dealer thinks that this is something that doesn't get a whole lot of activity, right, it's going to take them a while before they can sell it again. Well, the price they can buy for sell for, the difference in the two prices can get wider, right? They call the spread. That's their profit, by the way. Right? As a dealer, they buy at one price, sell at a different price. The difference between the two prices is called the spread, and that's their source of profit. Now, if the dealer thinks that this is going to be something that's going to hard to move, right? It's not going to go out of the inventory very quickly. They can, charge a different or wider spread on it. All right. Information about the issuer, for example, the slide says if a security has been called. Well, that, of course, is going to affect the value of that security. If it's been called, that means it's been cashed out prematurely. What else could it be? Well, what if the issuer has been downgraded or something like that? Right, their credit rating has been downgraded. That's definitely going to impact the value of the securities, right, in a negative way. Right, people usually want something safe, so if they don't want it, the price is going to start dropping until someone says, "Okay, I'll take a chance." Okay, now here's what comes when it comes to trading municipal bonds. So as a dealer in securities, is something that can be hard to find, right? Something that in inventory that can be hard to find. So one of the things that a dealer can make is a nominal quote. Now, a nominal quote is not the same thing as a firm quote. It's a best guess bid, basically. And they're not saying they're willing to trade at that price. It's just their guess at this moment. If they want to sell something and they can't seem to find someone who wants to buy it, they'll put out a BW, a bids wanted notification, and a bid wanted sell, saying they're looking for someone who wants to buy it. And maybe there's another dealer out there who's willing to sell it, right? Who's willing to buy it from them. If they want to acquire a security, but they can't find a place to acquire it from, they put in offer wanted. So they're saying, hey, I'll make if someone wants to sell it, I'm looking for your offer on it. Okay, they were looking to buy, and they're looking for someone who wants to sell. Okay, if a dealer gives a workable quote, that means it's an approximation. Now they have to work out the exact price, and maybe you have to do a little research to figure that out. But to say, okay, I'll give you this workable quote right now. So, okay, what will happen is a customer calls the broker dealer, says, I want to buy a municipal bond. the broker-dealer will call their trading desk and see what they have available, or they have to go to these dealers, other dealers in securities, and see what they have available. So they may have to call around for a bit. They may have to shop it around. Now, a lot of it's computerized now, but remember originally, this would be done by phone, and they'd have to make several calls, right? They have to get competing offers from different dealers. So depending how actively it was trading, that the dealer at the other end might, okay, I'll give this nominal quote, this is best guess, but doesn't, don't hold me to it. Or a workable quote, which is an approximation, and they'll work it out what they think is their actual price. Okay. Now, in new issues, so when a municipality wants to raise money, they'll they'll do a municipal bond offering. As we know, municipal bonds are exempt from registering with the SEC. They're an exempt security. And therefore, they're also exempt from the prospectus delivery requirements. They don't require a prospectus. However, even though it's not required, not legally anyway, they will actually have a disclosure document called the official statement, which does the job that a prospectus does, providing full and fair disclosure of all material facts to potential investors. Again, since they're not required to do it, but they will, because before investors want to make a commitment, before they'll commit their capital, they want to see a disclosure document. Like the manager of a municipal bond fund. He's going to want to see an official statement. He's going to want to see this kind of documentation. Originally, of course, there is a preliminary official statement, which will be replaced eventually with a final official statement. Preliminary, not a preliminary and final prospectus, a preliminary and final official statement. Now, if they're going to have an official statement, they do have to send it to a customer by the time of the settlement of the trade. And remember, settlement is 2 business days. If they don't have an official statement, then they have to tell the prospective customer that there is not an official statement. Will they disclose the spread between what the dealer, right, because remember the underwriter buys the securities from the issuer, turns around and sells them to their customers at a slightly higher price, right? Their difference, the spread between those two numbers is their source of their profit. Now, in a negotiated underwriting, yes, they do the spread, but if it's competitive bid, they don't. In a negotiated underwriting, the municipality, let's say like city council, for example, they've decided which broker-dealer firm they'd like to use as their underwriter, based on their reputation or previous history. So they will pick that underwriter, they'll pick that firm, and then they will negotiate the actual terms. Revenue bonds tend to do negotiated underwritings. Because remember, a revenue bond, right, they're not paid by taxes, they're paid by the revenue the project generates, right? They're self-sustaining. General obligation bonds, however, usually use a competitive bid underwriting. It's for general bonds, general obligation bonds. Because these are paid with taxes, remember, voters have to approve it generally, and they're going to put out a request for proposal. And anyone who's interested will submit a sealed bid. So if it's a sealed bid underwriting or competitive bid, then they do not require them to disclose the spread between the underwriter paid for them and what they sell it for. Securities must be issued now with a QSIP number, and a QSIP it's like a serial number. It's an identifier for every bond offering. Now, not each individual bond, mind you, not like every bond for $1,000. It's the bond offering, because we need a way to identify them. Because, City of Phoenix, for example, may have done tons of different bond offerings. How can you tell which is one from the other, especially have this similar descriptions to that? Well, they issue what's called a QSIP number, and that's like an ID attached to it. QSIP is like a Committee for Uniform Securities Identification. It's either procedure or protocol. I think it's procedure. Okay, but it's basically a serial number. That way we can tell if we're talking about the same municipal bond or not. Information about municipal bonds is held in a database, which the MSRB controls, and it's called EMMA, for Electronic Municipal Market Access System. Now, this is available to the public and to the industry with information about municipal bond offerings. So a new municipal bond offering, for example, will have, if you want to find their official statement, you can look it up in EMMA. If there are states that offer 529 plans, because remember, those are municipal securities. every state has its own 529 plan. So the details on 529 plans can vary somewhat from state to state. Pre-refunded bonds. Okay, now remember, that is where a bond has been, basically it's been paid off ahead of time. Let's say interest rates have gone down and this municipal government wants to refinance its bonds, right? To pay off these old bonds, which had a high interest rate, issue new bonds at a lower interest rate and save a whole lot of money. Only thing is they can't do that until either the bond matures or if it's a callable bond, at least until its callable date. They might have to wait a while. So what they can do is do another bond offering, sell bonds to investors, use the proceeds from that bond offering to buy treasury bonds, hold the treasury bonds in escrow, and then use those treasury bonds when the old bonds mature or they're callable, use the treasury bonds that are held in escrow and use them to pay off those old bonds. So those bonds, that's what they call them, pre-refunded. Basically, they've been paid off in advance by government bonds that are held in escrow. Information on EMBA can also find information about municipals, about the municipal governments, their finances, for example, and also price and yield information on muni-buy trades as they're reported. So you get as close to real time as possible. Okay, about advertising, their definition of advertising is somewhat different than it is for FINRA. The MSRB describes advertising as any material, written or electronic, about municipal bonds that goes to the public. Right? It's basically meant for more than one person. Right? Remember, FINRA says it's called retail communication if it goes to more than 25 people in a 30-day period. MSRB is basically says if it goes to more than one person, it's considered advertising. This does not include official statements. That's more like a legal document. Okay, those are excluded from the definition. Abstracts and summaries, however, they are considered to be advertising. Notice it says not excluded. You got to watch out for things like that on the test. You have to watch out for things like these sort of double negatives, right? They'll try and trick you with the wording. Not excluded means included. Not exempt means means exempt. Okay, right? That means that the not exempt means the rules do apply. So that's the way they try to trick you sometimes. You just got to watch out for double negatives, triple negatives. It drives me not uncrazy. If you're talking about advertising muni bonds secondary market for trading between investors after they've been issued, the advertising has to show the price or the yield when the ad was published. Now, notice it can give you either one, whether it's the price in dollars and cents, right, or they can give you the yield, which is the rate of return. As always, if it's a callable bond, you must always show the worst case scenario. They call it yield to worst, YTW, which is either the yield to maturity or the yield to call. Now, which would be the worst case scenario? Now, if you remember from your bond offerings, from your bond issue here, is that if it's a discount bond, for example, if it's a discount bond, that means the price has gone down. If the price goes down, the nominal yield stays the same, the current yield goes up, the yield to maturity goes up more than that, and the yield to call goes up more than that. Let me write this out for you here so you can see a little bit better. So if it's a case of it's a discount bond, okay, then the nominal yield is lower than the current yield, which is lower than the yield to maturity, which is lower than the yield to call. So therefore, if you give a quote to a customer where you tell them the yield, and the bond is callable, you'll have to use the worst case scenario. You'll use yield to maturity because it's lower than the yield to call. On the other hand, if the bond is trading at a premium, then the nominal yield is higher than the current yield, which is higher than the yield to maturity, which is higher than the yield to call. So in this case, as the price has gone up, the worst case scenario is the yield to call. So that's what you'd quote to a customer. That's what would be on a confirmation statement. Otherwise, if you said, hey, you told me the yield to maturity was this, but the bond got called away from me, and now I got a worse yield. Well, they'd have a point there. They definitely have an argument, and regulators would side with them. Okay, if dealers they don't have an inventory, they have to describe it, right? Subject to availability. You got to have that kind of disclaimer there, because if they don't have an inventory and can't find it, right, they may be hard to do so. The dealer attempts to acquire the bonds if customer by customer. And the ad states the bonds are subject to change in yield or price. Because if they don't have it, they got to go get it. They got to go find it, and at whatever price it is at that moment. So you have to give those kind of disclaimers here. And it's fair to do so, because after all, there's the chance that prices move or yields go, and of course, if the price changes, the yield changes in the opposite direction. Municipal advertising, right, has to be approved by a principal, right? So a principal means the supervisor has to approve any ad, and they must keep it on file for 4 years since the last time the ad was used. Right, so the very last time that they ran, they have to keep it in there on file for 4 years after that. Okay. Now, what about the case of political contributions? Now, as we said, these broker-dealer firms, right? Many of them will compete and to do the underwriting on a municipal bond offering. So, making political contributions to city council members and mayors and state legislatures and stuff that have the authority to choose your firm, right, in a negotiated underwriting, well, that could certainly create the appearance of a conflict of interest, and might actually be a conflict of interest itself. Now, if a firm, right, does make a political contribution to a candidate or to a political action committee, they may not engage in securities business with that municipality for 2 years. Now, again, I'm only talking about negotiated under offerings. There are negotiated underwritings. If it's a sealed bid underwriting, that's all right because it's a sealed bid, and right, the lowest bid wins. So that won't matter, but it will be for negotiated underwritings. They cannot solicit business for 2 years. Now, there is a de minimis exemption on that. De minimis meaning of a minimal amount, an amount so small that they don't think it matters. A firm or a municipal finance professional, MFP. Now, a municipal finance professional is an employee of a broker-dealer, but one who specializes in working with municipalities, with municipal governments, in consulting with them and helping them put together an offer that would attract investors. So they can make political contributions, but they're limited to $250 per candidate per election cycle. So if city council is elected like 4-year terms, $250 every 4 years, and that employee must be eligible to vote for that candidate. If it's more than $250 or not to someone they're entitled to vote with, then they got a 2-year ban. Okay, so they consider a minimum amount is such a small amount that it cannot curry any favor or create conflicts of interest. Okay. All right, so again, a municipal finance professional, as it says specifically, is an advisor working with the underwriting for municipalities, does not work with retail clients, right, is working specifically with municipal governments. All right, and those are the MSRB rules, which again, as they see, they're somewhat different sometimes than they are for FINRA rules. So you have to be a little cautious when you read test questions, because if it says something like according to MSRB, you might have to use a different set of rules. All right, how are we doing on this stuff so far? Okay, thank you, Ashley. All right, well, basically we got another chapter here to go. So before we go to another chapter, we're still 15 minutes or so to our next break, but let's go ahead and bring up another Kahoot. It's a smaller one this time, but if you give me a moment here, I'll prepare that for you. And this time I remember to share the screen. Okay, let's get our PIN, and our PIN is 9366932. All right, okay, got on there. That's great. All right, let's go ahead. Okay. First question, what is the spread in ABC? ABC is the current quantity of books, so the size. So what is the spread? It's A 20 cents, A 25 cents, C 30 cents, B 50 cents. Give it a guess. Okay. All right. Sorry, that was a little, that one. I know that was a little tricky to start out with because you had to kind of look at this to begin with. All right. What we have here is a over-the-counter stock. Now, remember, in the over-the-counter market is a competing dealer market, right? They're called market makers. As dealers and securities, they'll buy at one price and sell at a different price, but they compete with other dealers, and so you shop around basically the best price. That's why the over-the-counter market is called a negotiated market. You're negotiating for the best price. Now, the bid price represents the price that one of these dealers will buy it from you for, okay? That's what they're bidding. So if you want to sell it, you sell it to the bid price, but you're going to sell to the highest bidder. So, oops, sorry, who's the highest bidder? That's the third one down, right? $10.25. So if you want to sell it, you'll sell it to them because they'll give you $10.25 for it. The ask price represents the price that these dealers are willing to sell it to you for at this particular moment. Now, of course, you're always going to go to the lowest ask price, right? Who's asking the lowest price? Well, that's market maker number two, right? Who's asking or offering it at $10.45. So the difference between what you can buy it for and what you can sell it for, so you can sell it at $10.25 and you can buy it for $10.45. The difference between the two prices is the spread, and that is 20 cents. Okay. I know that was maybe just because you kind of had to work quickly on that to see that might have been a little difficult. Let's check our next one. What is the inside quote of ABC? Okay, so we see the chart again. The bid price, three bid prices and three ask prices. What is the inside quote? Is it A, 1020 to 1045, 4 by 3, 1025 to 1050, 3 by 2? All right, I didn't even have to finish up. So let's take a look at this one. So the inside quote means highest bid and lowest ask. The highest price anyone will buy it from you for, and the lowest price anyone will sell it to you for. So 1025 is the highest bid. Now the size, which we see here on the right column, tells you how many round lots of shares, and a round lot is 100 shares, the dealer is willing to buy it for and sell it for. So dealer number 3, for example, bid 1025, ask 1060, 3 by 2. So this dealer is willing to buy 300 shares at $10.25 and will sell 200 shares, right? That's the 2 there, at $10.60. Now that's the one, if you want to sell it to, they'll buy 300 shares. But I don't want to, if you want to sell it to them, right there, okay? But I don't want to buy it from them at $10.60. I want to buy it from dealer number 2, who's willing to sell it at $10.45. And the size of 3, which is on the ask price, that this dealer is willing to sell it 300 shares at $10.45. So I'm going to take these two best prices, the highest bid and the lowest ask, to make the inside quote. To figure out the size, how many shares are wanted to buy or sell, I'll take the bid price, the highest bid, which is $10.25, and the size of 3, to say there's 300 shares they're willing to buy from you at $10.25. I'll look at the ask price, which is $10.45. Right? This one's willing to sell it to you at $10.45, and they said they're willing to sell 300 shares at $10.45. So that's what makes D our best choice. All right, Karina moves up. Let's check our next one. A customer is given a quote for ABC at 17 to 1725, 6 by 12. This quote indicates the customer can A, purchase 1,200 shares for $17 per share. B, sell 600 shares for $17 per share. C, purchase 1,800 shares at $17.25 a share. Or D, sell 1,200 shares Okay, so we have to, in understanding the price quote, you always get two prices. You get a bid price and an ask price. So it's always bid first, ask second. When the price quote is 17 to 1725, it's like a shorthand notation that says the bid price that most anyone's willing to pay for right now is $17 a share. So if you want to sell your stock right now, there's a dealer willing to buy it from you at $17 even. So you can sell it at $17 a share. The second price, $17.25, is the ask price. This is the lowest price that anyone's willing to sell it to you for at this particular moment. So if a customer wants to buy, they can buy at $17.25. The size, right, which is the 6 by 12. Again, it's like a shorthand notation. How many round lots with 100 shares are wanted to buy at the bid, and offered for sale at the ask. So this shorthand notation says there are 600 shares that are wanted to buy at $17, and there are 1,200 shares offered for sale at $17.25. So the one here that was really closest, was really accurate, was they could sell 600 shares at $17 per share. So what I did was had to match. Was a purchase the 17? They'll purchase because you buy at the ask price, you sell at the bid price. So choice C, to purchase at $17.25, yes, they could have, but they could not have purchased that choice at 17. No one wants to sell it for 17. Could they sell it for 17.25? No, no one was willing to pay 17.25 per share. So this is what happens with this quote. If you need any help with this, do please let me know, okay? You're not sure? Okay. Okay, having just gone away from it, I'll have to come back to it. Next question. The ask price represents A, one of the prices set by FINRA. B, the price the broker-dealer will sell for. C, the price the broker-dealer is willing to buy for. Or D, one of the prices set by the SEC. Okay, very good. It is the price that the dealer will sell for. The ask price represents the lowest price anybody out there, any of these dealers, are willing to sell for at this particular moment. So basically, when someone wants to buy, they'll pay the ask price. They'll pay what someone's asking for it. Kind of think of the ask price as if you go to a car dealer and you see a sticker on the window. Well, the ask price represents the price you'll pay for it, and the dealer will sell it to you for at that moment. Now, which is the one that the dealer is willing to buy it for? They're willing to buy at the bid price. So if a customer wants to sell, they sell to the bid price because they're selling to the highest bidder. Now, fortunately, no one chose FINRA or the SEC. They are regulators. They're not actually market participants. Okay, Alexis moves up. Pretty good. Next question. Subject to market liquidity, which of the following orders is most likely to be executed immediately? A, fill or kill. Limit. C, or D, It is a market order that is executed immediately. Market order means trade, buy or sell at the market price, whatever that price is at that moment. Market orders are the most common order. They are the fastest order. They're nearly instant execution, and they are guaranteed fulfillment. The order will be fulfilled at market price. What's not guaranteed is the price, because prices fluctuate, sometimes rapidly, but definitely the order will be fulfilled right away. Limit orders, someone sets a price that they want. Well, if the price that they want is not actually at the market price, well, it may take time to fill that order if they ever do. Fill or kill or all or none orders, these are also limit orders, right? There's a specific price they want to buy for or sell for, but they fill or kill order means the order must be fulfilled in its entirety immediately, and if it's not, it's canceled. In an all or none order, the order must be filled in its entirety. They will not accept a partial fulfillment of the order, but they'll let that order be as an open order, as a standing order, either for the day or good till canceled. All right, well, I saw a floating, thinking about it emoji. So suggesting this is not totally 100% clear. Okay. Market orders will be fulfilled immediately. Not just most likely to be, but definitely will be. Market orders are instant execution at market price. The order will be fulfilled and they'll buy or sell it at whatever market price is. So if someone wants to make sure that the order goes through, they'll get it, right? They just cannot absolutely guarantee them a price. All the other orders have limit prices to them. A limit order means someone setting a limit, the most they're willing to pay if they're buying, or the least they're willing to take if they're selling. Now, a limit order might not be fulfilled right away. I want to buy it for $25, but the actual price is $25.25. So I probably can't buy it at $25, at least not right now, at least not unless it comes down by 25 cents, which may or may not happen. All right. Fill or kill or all or none orders are orders with qualifiers on them. In both fill or kill or all or none, they will not accept a partial fulfillment of an order. If they want 1,000 shares, they will not take anything less than 1,000 shares. If someone places a limit order and they say the price they want, they say they want to buy 1,000 shares, but there are only 500 shares available at the price they want. Well, unless they specify otherwise, it's assumed that they will accept a partial fulfillment of the order. They'll buy the 500 shares that were available, and they'll continue to work and try to buy the other 500. All right, but those orders, and also, by the way, orders with special instructions like fill or kill or all or none, they don't go in the regular system. Orders have to be handled manually, not electronically. Okay, thanks, Karina. Thanks for your thumbs up. Okay, anyone else? Are you good with that? Or if you're not so good with that, it's time to let me know. Okay, thank you, Alexis and Ashley. Okay, all right, Alexis moving up a few more points. What is the spread on a stock quote? A, the profit margin for individual trade. B, the difference between the bid price and the ask price or offer. C, the broker-dealer's commission charges for the transaction. D, okay, you got a chance to finish it. Hey, you nailed it. Difference between the bid price and the ask price is the spread, and that's the source of profit to a dealer in the firm. The choice C about being a commission is done if it's an agency transaction, right? Matching up buyers and sellers. They get the spread as their part of their markup or markdown when they act as a dealer or a principal in the transaction. Alexis, 3 in a row. Unless otherwise specified, the size of a firm quote is A 100, B 500, C 1000, or D 10,000. Correct. Okay. They'll always be right. They trade in round lots of 100 shares. That's just the standard unit of trading. Stocks are bought and sold 100 shares at a time. Now, it is possible to buy and trade less than 100 shares. That definitely is. That's known as an odd lot. But the standard unit of trading is like eggs are bought by the dozen, right? Beer by the 6-pack. Okay, you can get a half a dozen eggs, but you might have to pay more per egg to do so. Okay, more points. Let's check our next one. Which of the following best describes the size of a quote? A, the number of shares that were traded on the NYSE that day. B, the number of shares that were available on a buy or sell at that price. C, the number of shares that were traded in the OTC market the prior day. Or D, the number of shares that were as That's it. Yes, the number of shares a broker deals when a buy or sell. That's the size. We saw a price quote earlier. It was like 10 to 125, and the size was like, what does it say, like 3 by 6 or something? How many shares are wanted to buy at the bid price, and how many shares are offered at the ask price? That is the size of the quote. And by looking at that, we can now get an idea of liquidity. Meaning if you want to trade a large block of shares, for example, right, it might be more difficult to fill a larger order. The number of shares traded on either the New York Stock Exchange or over the counter, that is called volume. Volume is the number of shares traded. Alexis is 5 in a row. Oh, let's check the next one. The inside bid is good for A 100. Okay, market earlier. Inside bid is good for 100, B 200, C 300. Let's take a look at the quote. Little difference of opinion again. So let's take a look and see what it looks like. So we look at the inside bid. That's the highest bid price, comes from market maker 3. They're willing to pay the highest price for now. So if you wanted to sell it, that's who you want to sell it to. The one who'll give you the highest price at $10.25. Now we look at the size. How is it good for? How many shares? Well, that's the 3 in the 3 by 2. That is how many shares. There were 3 lots, 300 shares, wanted to buy at the bid size of $10.25. That's what this is telling us. Alexis, 6 in a row. Ooh. All right, last one. The spread a dealer makes is best described as A, the total commission, B, the ask plus the bid, C, the ask minus the bid, or D, none of these. Ask minus bid, the difference between the two prices is the spread, and that's the dealer's profit. Good. Now, something like none of these, I am super skeptical before I see it's like a none of the above, cannot tell from the information given, anything like that. Okay, in third place, bronze medal is actually in second place, silver medal, discovery one. And in first place, gold medal and Olympic champion, Alexis. All right. Hey, big round of applause, baby. Here's all the great job. Let's close this one out. All right. So before we return to our, this will actually be our last chapter here, which is on economic analysis and taxes. We're going to head. Let's go. It's 8 o'clock, top of the hour right now. Let's go ahead and take another break. Let's go ahead and break right now, and return at 11 past the hour. And again, if you have any questions on that, anything we've just gone through, do you need help with that bid, ask, and size? Please let me know. All right, just send me a message or unmute. You can ask me verbally too. All right, and that I'll see you in a few minutes. All right, I think this is working again, so welcome back from break. Okay, still connected, right? Okay, thanks, Alexis. Okay, and Ashley. All right, I just good to have just to know that things are working. It just helps to know. All right, final chapter here. Okay, so with the rest of our day, we'll go into economic analysis and tax rules, and we'll pick up with this again on Wednesday. Okay, so let's go over here. So about economic analysis. Now, again, it's a small part of the overall test about economics. It's not real big. There will be some questions on it, so you do want to know some economic fundamentals. Now, one thing we want to know about is well, one of which is how we measure the economy, and the economy is mostly measured with what's called gross domestic product, GDP. Now, that's the main thing we use to measure the overall economy, and it's basically the entire output of the United States economy in a year's time is our gross domestic product. Now, as you might imagine, that's a pretty big number, but everything that's produced within the U.S. is included in gross domestic product. Now, it does include, as it says, consumer spending plus government activity and business activity too. Now, for example, it mentions here anything that takes place in the U.S. government. So there is, for example, there's a Toyota plant in Ohio. Now, Toyota, of course, being a foreign company, but having a plant in the U.S., right? Its production, right, whatever it puts out, is part of the U.S. GDP. Now, there is another number that's used. It's not used as often. It's called gross national product. Gross national product is everything that a country produces or its country's citizens produce, but it's produced anywhere in the world. So the Toyota car that's the Toyota factory in Ohio is part of gross domestic product because that's within U.S. borders, but it's not part of gross national product because it's not actually a product of a U.S. citizen or a U.S. company. Gross national mentions if it's a Ford car that's produced in the UK. Now that would be part of the U.S. gross national product. Coca-Cola, right? They sell bottles of soda all over the world. Everything that Coca-Cola sells in the United States is called gross domestic, is part of GDP. Everything that Toyota sells everywhere in the world is part of GNP. Okay, now we want to know also about the business cycle. Now, everything in the world goes in cycles, right? Just sometimes different things go in different cycles. There are 4 specific phases of the business cycle, and they go in up and down fashions here. And we want to know what the phases of the business cycle are. Let me see if it's on another. Yes, it's in another slide, but it kind of looks like this here, right? Up and down like this. So the 4 phases are expansion, peak, contraction, and trough. So you see here, right? So as it's going up here, that's an economic expansion. That's where GDP is growing, right? And businesses are hiring, and inventory is moving out of warehouses, and people have more money to spend, and the economy is in an expansion phase. Now, eventually, it will eventually happen, and it cannot just always begin to happen, that the economy hits a peak, right, at its lowest point. Now, by the way, this part here, right about the top of the expansion, this is where inflation can become a problem. Okay, so there's inflation risk coming up here because this is where basically inflation is the negative side effect of a too rapidly expanding economy. Right, there's too many dollars chasing too few goods and services. So it becomes the highest point of the expansion, and at some point it will invariably happen. Can't tell you when, can't tell you why, just that it will. So the economy will go into a contraction. Now, in economic contraction, business starts to slow down. GDP is reducing. Inventory is building up in warehouses. Merchandise isn't moving as quickly. Companies start to have layoffs because their business is slowing down. Fewer people have a paycheck, so they stop spending as much, and the economy eventually goes into a contraction. When a contraction becomes severe enough, and it's severe enough means if GDP it drops for 2 consecutive quarters. Well, 2 consecutive quarters, that's about 6 months. So GDP contracts for 6 consecutive months. That's the definition of a recession. And if it goes down for 6 consecutive quarters, then that would be 18 months. That's a year and a half of economic contraction. That's the definition of a depression. Right? If the economy's been contracting for a year and a half, I might be pretty depressed too. At some point, eventually, they'll try to stimulate the economy. They'll reduce interest rates. Prices of things will start coming down again to the point where people start buying. When people start buying, then inventory starts moving out of warehouses again. And when inventory starts moving out again, then companies start hiring again. So the trough is the lowest part of the contraction, and at that point, it turns around, goes up again, and becomes they might call it economic recovery out of the trough, or you might just think of that as expansion part 2. Okay, and then eventually hits a peak, and then contraction, and then trough, and then expansion, peak, contraction, trough again. So those are the 4 phases of the economic cycle. And if you know the 4 phases, if you know the order that they come in, you get the right answer. The test might give it in a different order. It might say contraction, trough, expansion, peak. But if you know the order, you get the answer. In fact, I would expect you to be an expert in the economic cycle. Expect expansion, peak, contraction, trough, or expert expansion, peak, recession, trough. So that's how you might remember the order that they come in. To try and manage the overall economy, because originally in an unmanaged economy, well, there would be all these boom to bust cycles, right? You have this big economic boom, which followed by this economic bust, okay? And some pretty severe contractions sometimes. And the biggest bust of all, of course, was the Great Depression, from 1929, the 1930s. So I say, well, how do we not let this happen again? Are there ways to manage the economy, at least to some degree, so at least it's not so much of a roller coaster ride to help smooth out those up and downs? So there are different economic policies that are put into play to help try and manage the overall economy. So you can't eliminate the business cycle, but you can at least make it not so dramatic. Now, our economies are managed by fiscal policy and by monetary policy. Fiscal policy specific is government action, and it's government policies that have to do with the economy and really has to do with government policies about taxes or about government spending. So to try and stimulate the economy, okay, to be a dovish, which means they try to stimulate the economy, they can reduce taxes, right? All right, which again puts more money in people's pockets, or increase spending, right, into programs or into building projects, which means money's being spent, and okay, and they can do that, right? The New Deal from the Great Depression, right? That was the whole idea, was create all these new government agencies. So if nobody was hiring, at least then the government would hire somebody to do something, and at least somebody would then have some money to spend, okay, and try to stimulate the economy. So they can try to stimulate the economy if it's in a contraction by reducing taxes and or increasing spending. On the other hand, if the economy is growing and it's growing at too fast a rate, and again, inflation becoming the negative side effect, then they can try and slow down or cool down the economy, maintaining a hawkish tone, as they say. Okay, and they can do that by raising taxes and or decreasing spending. So again, that takes some money out of the economy to keep the economy from overheating. All right. Now, so fiscal policy, remember, is always government actions and would have to do with government. It's basically it's Congress and the president, mainly Congress, of course, and their policies about taxes and government spending programs. Now, our other policy is monetary policy. Monetary, as your name means money, and those are the rules of the Federal Reserve, because the Federal Reserve is the central bank for the United States, and they controls the money supply, which is how much money is available in circulation, and it's circulating now. So they can increase or decrease or expand the money supply or tighten the money supply to try and stimulate the economy, right? So they can expand the economy by loosening credit, lowering interest rates, having more money in the hands of banks so that banks have more money to lend out to businesses, right? And they can use that to expand their business that way. And also, it's not on the slide here, but of course, they can try to contract the economy. So they can contract the economy when it's becoming overheated. And they would do things like tighten credit, okay, raise interest rates, okay, right, and reduce the money supply so that fewer dollars are in circulation to prevent the economy from overheating, from going too hard. So the Federal Reserve has certain tools at its disposal. What it can do to try and stimulate the economy or slow down the economy, contract the economy. And they can use the same tools either way. They use the same tools to stimulate the economy or to cool down the economy. It's like turning a faucet one way or the other. So their tools include, well, one is setting the discount rate. Okay, you hear on TV, is the Federal Reserve is meeting, are they going to change interest rates or raise rates? That's the specifically is the discount rate. It is the only rate that the Federal Reserve controls. Specifically, it is the rate at which member banks, can borrow from the Federal Reserve. See, banks have to have a certain amount of money on deposit compared to their outstanding loans at the end of every day. And if they're short on that amount, they can borrow that money short term by borrowing it from the Fed at the discount rate. So that's the only rate that it controls. But you say, well, if that's the only rate it controls, why is it such a big deal? Why does it make the news? Well, it's because there's a domino effect. When the Fed changes the discount rate, it won't take long. It'll take same day, I'm sure, that the major banks will start to announce changes in their prime rates, right? The rates at which they lend to their A-list corporate clients. So if they want to tighten credit to slow down the economy and take a hawkish stance, they can increase the discount rate, right? The rates go up. As you notice, the rates have gone up rather quickly in these last several months. If they want to stimulate the economy and loosen credit, they would lower the discount rate. Remember, back in COVID world, they reduced the discount rates to just about nothing to make sure that there was liquidity and stimulate the economy. So they take a dovish stance. That's what they call that. Okay, so that's one of the tools they have is the discount rate. Now they don't change the discount rate that much. They only meet every so often, maybe like on a quarterly basis, unless they have some sort of like impromptu or emergency meeting if they think they need one. And they don't usually change the rate all that much, so it doesn't happen a whole lot. One thing they do, however, which can be a daily operation, is called open market operations, or OMO. So in open market operations, the Federal Reserve is basically either buying or selling treasury securities from banks so that the banks can either have more cash available or less cash available. So what they do is they try to ease the economy or loosen the economy with repurchase agreements. As a repurchase agreement, the Federal Reserve will basically buy a treasury bond from a bank. So the bank has a treasury bond, sells it to the Federal Reserve, with the idea, with the repurchase agreement that says the bank will buy it back from the Federal Reserve, could be as much as a day later, at an ever so slightly higher price. But by doing so, what will happen is that the bank will sell its treasury bonds to the Federal Reserve. Now the bank has more cash. If the bank has more cash, now there's more money available to lend out to businesses to help them, to expand and grow their businesses. And since there's the supply of money that they have, well, we know that the price of anything is supply and demand. If there's an increased supply, it would cause the cost of money, and the cost of money is interest rates, right, to lower. Money is a commodity, right, which is bought and sold, and the price you pay for money is interest rates. So if they increase the supply of money that's available to banks, it causes their supply to increase, and therefore the price of money or interest rates to lower and make money more available, easing credit to businesses. However, if the Federal Reserve wants to tighten the economy, slow down the economy, and take money out of the banking system, then they would buy securities, they would sell treasury bonds to banks. That's called a reverse repurchase agreement. In a reverse repo, the Federal Reserve sells treasury bonds to banks. The banks pay out cash. Now the banks have less cash available, less money available to lend out to businesses. And since their supply of money has just reduced, that would cause the cost of money, the interest rates, to rise. Okay. So now this open market operations, it can be a daily operation, and this affects or influences anyway the federal funds rate. The federal funds rate is the interest rate that banks lend to each other. That's the bank-to-bank rate. The federal fund. So if one bank is short on its reserve requirements, the money it has to have on deposits, it could borrow from another bank, even as short as overnight, but just to make sure they have what they need at the end of the day. So banks lend to other banks at the federal funds rate, or banks borrow from the Federal Reserve directly at the discount rate. Okay. Another tool that they have at their disposal, they can use it, but they never do. And they remember under Regulation T of the Federal Reserve of the Securities Exchange Act of 1934 gives the Federal Reserve the authority to set the initial margin requirement, right? Basically the down payment that they have to make in a margin account, which is currently set at 50%. Right? Regulation T says the margin requirement, you basically have to make a 50% down payment and borrow the other 50%, or can borrow the other 50% from a broker dealer if they have a margin account. Now the Federal Reserve has the authority to change that either up or down, but they never do. In fact, they haven't since like 1974. Why not? Because it's just such a small part of the economy. It just doesn't have an impact. It doesn't move the needle. But conceivably, if they want to tighten credit and slow down the economy, they can increase the margin greater than 50%, or they can stimulate the economy and loosen credit by lowering the margin requirement below 50%. Can never do, which, by the way, is very good for us in taking this test. Because since they set it at 50%, it makes doing the math a whole lot easier than if it was 45% or 55%. All right, now one other tool that they have is rarely used, and that's they set the reserve requirements. Now this is the big impact here. This is the wrecking ball requirement here, right? This is the tool they have. This is massive impact on it, because it's the reserve requirement is how much money that banks have to have on deposit in their vaults at the end of the day relative to their outstanding loans. So they set a reserve requirement, and that means the bank can lend whatever's left over. So it's like the slide says, if it's set at 10%, the bank can lend the other 90%. Now they can either increase the reserve requirement, which would tighten the money supply, because now there's less money available to lend out to businesses, or they can ease the money supply by lowering the reserve requirement. They say from 10% down to 9% or something. Now there's more money lent out. Now they rarely use this tool because there's a multiplier effect. Even a small change in the reserve requirement basically has a massive impact on the overall money supply in the economy. Because it's okay, if it's set at 10%, now they set it down to 9%, that extra 1%, banks can lend out. And it goes to another, they lend it out and it gets deposited in another bank. And then that other bank can lend out 9%, right? 91% of that, and they deposit to another bank and so on. So there's a huge multiplier effect that happens. And so they very rarely use this because of this, the big impact it has. Small change has a big impact. To help us understand the economy and the way that we decide how we're going to manage it comes down to these economic theories. And these economic theories basically say this is how the economy is best to be managed and what are the most impact on the economy. So there are three types of theories that they may ask about on the test. One of them is called Keynesian theory, and that's how you pronounce it. Keynesian, not Keynesian, Keynesian, because it's named for a British economist, okay, whose name was John Maynard Keynes. Okay. All right. So in Keynesian theory, under John Keynes, this basically holds that the economy is managed through fiscal policy, right? Government action is the main driver of the economy, and therefore is a country's duty to try and still manage the overall economy through its policies regarding taxes and government spending, which, as we said, right, with fiscal policy right? To either stimulate the economy by lowering taxes or increasing spending, or contract the economy by raising taxes and lowering spending. So basically, Keynesian theory says that the main driver of the economy is government action, and it's the government's responsibility to manage the economy appropriately. But another theory has a different point of view. That is called monetarist theory. Monetarist theory holds that the money supply, which is the purview of monetary policy, which falls under the Federal Reserve. Okay, so let me make some notes here. So Keynesian theory is government action, right? So it's basically Congress. So Congress, government. Okay. Monetarist theory, which is the money supply, and this is the result of the Federal Reserve in controlling the money supply, about how easy or difficult it is for business to gain access to credit, and that's the main driver of the economy. Another theory is called supply side theory, and supply side theory holds that it is the marketplace that is the key driver of the economy, of supply and demand, and that supply and demand finds its own levels, and that government action should be minimal, right, with less regulation or lower taxes, and that provides incentive for businesses, to produce products that people will buy and gain profit that way. Now, are there any one of these theories maybe better than the other? I have no idea. But it's just the idea that these are the theories behind them. But we see them all in action. In fact, remember in COVID world, okay, we saw all these things going on. We saw Keynesian theory take place in fiscal policy because we saw, we got stimulus checks so that people would have some money so they can keep spending it, right, to keep the economy going. We saw the Federal Reserve lower interest rates, lower the discount rate to just about nothing. And in its open market operations, buying bonds that normally they wouldn't buy, right, with higher risk to them because they want to make sure that there was liquidity in the system. And I think just day to day, every day, we see supply side theory just working its way through in the supply and demand of what consumers want to buy or sell. Okay. So I think we kind of see all these things in action. Okay, ways to look at the economy too. One thing we look at to measure inflation is the Consumer Price Index, CPI. What the Consumer Price Index does, it takes a list of different goods and services that lots of people buy, okay, and they would compare its price over a period of time. So they would use that as the standard measurement of inflation. So if the price of a pair of I don't know, whatever it might be, right? The price of a pair of socks, for example, right? Or price of paper towels. Okay, it was, last month the paper towels was 99 cents, and this month it's $1.19. So it's kind of showing the impact here of inflation by comparing prices on things that people tend to buy. Let me see, I don't think it's on the slide. Let me just check here. No, it's not on the slide. So there's another one, not so likely to be asked about, but it's called the Producer Price Index, PPI. So the Producer Price Index, these are the price of things that, basically the commodities, right, that go into the finished product. So the price of a pair of socks will be in Consumer Price Index, but the price of cotton is in the Producer Price Index, right? So, and, steel and wood, things like that would be in Producer Price Index. Okay, so inflation, now we see the effect of inflation as the price of things going up, measured by the Consumer Price Index overall. And we can also think of that as inflation as being basically the lowering the erosion of the value of a dollar, right? $1 does not buy as much stuff right now that it did previously. Deflation, however, unlikely to see that, but that is the price of things going down. I mean, it can conceivably happen, but remember that's more likely to happen if there's a severe economic downturn. Prices have to come down because otherwise nobody's buying. So while inflation seems bad, deflation can be even worse. A small amount of inflation, by the way, is actually considered helpful because it provides some extra growth level in the economy. But as we've seen more recently, a high level of inflation can have some very, very difficult impacts. Disinflation is a little bit different. It's the decrease in the rate of inflation is disinflation. So that's what we've seen maybe more recently. because if the inflation rate is, I don't know, was it 7%, 8% or something? All right, now it's 4%. Well, okay, it's still inflating. There's still inflation here, just not a slower rate. So that was called disinflation. Okay, the real interest rate, or you might even call it real return, is the return on investment minus inflation. So that's just not what does it say you make, what do you actually get to keep? So based on inflation. So here it tells us if T-bill rates are 8%, and I don't know if we've ever seen T-bills at 8%, but there's a 5% inflation rate, then the real interest rate, right, you're really coming ahead by 3%. But at least you're coming out ahead. I've had to remind people, I might have told you this before, but people say, oh, I'm happy making 2% of my money because I know it's safe. Well, if you're making 2%, but inflation is like 3%, you're not really coming out ahead, are you? So we have to, that's one thing we have to measure about keep inside about inflation. Now, to help us figure out, well, there's an economic cycle, but how do you know where you are on the economic cycle? Are you in expansion, contraction? Where are you now? That's why there are different economic indicators. The leading indicators are the ones that say this is where the economy seems to be heading. All right, so they seem to, they're pointing out what is likely coming up. There's always a prediction about the future, so there's always some room for error there, but that's where at least the likelihood is. Some of these indicators include new consumer goods, unemployment claims. So if unemployment claims are going down, that's indicating the economy would be expanding because now more people are getting jobs, and it won't be a little will be a little while they'll start getting some paychecks. An increase in building permits and housing starts because construction companies are applying for permits because they expect to be able to build something and then sell it to somebody else. Okay, stock prices is measured by a market index like the S&P 500. Okay, also a leading indicator because the stock market is kind of a forward-looking mechanism, right? What about anticipated future profits and the levels of the money supply? Okay, well, the money supply is measured what's called M2. In case they ever ask you that, money supply. M2 is basically how much money is in circulation. So if there's a lot of money in circulation, that can cause a pickup of the economy, but we have to be cautious that it could cause start to at some point create an inflationary cycle. All right, so the leading indicators show where things seem to be heading. The coincident indicators, this is what's showing is going on right now. What part of the business cycle is it currently in? Now that includes such as personal income, because that's what people have to spend with their both discretionary and disposable incomes. Industrial production, what are factories turning out right now? How's things rolling off the assembly line? The current levels of employment and, of course, gross domestic product are showing what's happening currently. The lagging indicators, those are the ones that confirm what just happened. Okay? So that's what just recently happened and is the confirmation of that. For example, how long people are staying employed. Right? That would indicate whether, if people still have paychecks coming or not. Inventory and labor costs, corporate profits. After all, corporations don't report their profits until after they've actually had them and had some time to count them up. Okay, now a way of also looking at the economy is by measuring the yield curve. The yield curve is a graph, right? That changes over time. But the graph shows at this moment what the yield is on different bonds based on, and their length to maturity. So the horizontal axis, across the horizontal axis, right, is the length to maturity from short term to long term. And the vertical axis is the yield, which is the rate of return. Now, the normal yield curve, right, is an upward slope, right, from lower left to upper right. So in that short-term bonds have a lower yield, longer-term bonds have a higher yield. And you expect that, right? You expect people to want to get paid more for agreeing to tie up their money for a longer period of time, and therefore having that more extra risk of exposure to it. So the yield curve is right. The normal yield curve is the way things usually appear, right? Short-term rates are lower, long-term rates are higher. Every once in a while, the yield curve starts to flatten out. Short-term bonds are now paying just about the same as long-term bonds, not all that much. This is happening in an economic peak, generally speaking, and usually the result of the Federal Reserve action. Remember, the Federal Reserve, when they use their economic tools like the discount rate, that affects short-term rates to a much greater degree than long-term rates. So the yield curve starts to flatten at about the peak. Every once in a while, it doesn't happen a whole lot, but it's happened recently, is that the yield curve flips upside down, an inverted yield curve, in which case short-term rates are actually higher than long-term rates, the exact opposite of what you would expect. Also, perhaps from the result of rather severe impact from the, let's say, really uh, forceful action by the Federal Reserve, like recently how they really had to like put the brakes on the economy by raising interest rates quite a lot faster than normal. Of course, they had to drop it a whole lot faster than normal previously. Now, sometimes they considered a inverted yield curve can be a warning sign of a potential recession. Okay, I say, well, why would that be? Well, one reason that the yield curve might be turning inverted is because investors are getting nervous. Right? They're getting nervous about the economy, so they want to lock in their long-term rates now, so they'll start buying more long-term bonds to lock in their rates. Well, that means the demand for long-term bonds is increasing, and that would cause the price of long-term bonds to increase too. Well, if the price goes up, what happens to the yield, right? The yield goes down. At the same time, however, investors are not buying short-term bonds. They're ignoring short-term bonds, which creates the demand for short-term bonds to go down. If the demand goes down, then the price goes down. And if the price goes down, well, then the yield goes up. Okay. Does it always say, is it always a recession? Not always. Nothing's always happens, but can be a predictor of certainly a potential recession. Okay, now we can also look at the yield curve by drawing several lines on it, including what's called the credit spread. So they might draw the yield curve showing what corporate bonds are doing, what treasury bonds are doing, what high grade or high yield bonds are doing, okay, or even what municipal bonds are doing, and you might see several lines across the yield curve. All right, now now what happens is the spread between the difference between the yields of a treasury versus, let's say, a corporate bonds, right? That's called the credit spread, the difference between them. When the yield curve gets wider, this potentially accompany recession, right? Because why? All right, investors are getting nervous. They don't want to buy into corporate bonds because now they're having risk. They want the safety of treasury bonds, which means they start buying treasury bonds. And since the price is right, that which caused the demand for them to go up. And when the demand goes up, the price goes up. And when the price goes up, the yield goes down. So you get wider between them, between, let's say, corporate versus treasuries, that's a potential recession. On the other hand, when they get narrower, now that might indicate expansion, right? Investors are feeling more confident. They're willing to take more chances, and they're willing to put their money into corporate bonds rather than government bonds. So therefore, the demand for corporate bonds goes up. Therefore, the price of corporate bonds goes up, and therefore the yield goes down. So the lines get closer together. All right, and then I think for the day, we look at the balance of payments. Balance of payments is basically money coming in and money coming out of the United States. And the balance of payments, they can both have a trade surplus or a trade deficit. If there's a trade surplus, that means the U.S. economy is selling more goods outside to other countries than it's importing, than it's buying from them. A trade deficit tells us we're importing more than we're exporting. And yes, the U.S. economy does normally run at a trade deficit. What might happen, though, is that what happens with the exchange rates can also have effect on trade surplus or deficit. So, for example, when the dollar is stronger, okay, then U.S. imports increase and exports decrease. If the dollar is stronger, let's say to buy a Ford or a Cadillac, right, from another country, well, it takes more of their other country, it makes more of their currency to buy a U.S. dollar. So the price of a Ford or a Cadillac in another country goes up. Well, if the price is going up, the demand for them is going to go down, right? And okay, so the exports decrease. Meanwhile, okay, with a strong dollar, it doesn't take nearly as many U.S. dollars to buy euros or yen or something like that. So the price of a Toyota in the U.S., right, it doesn't take as many U.S. dollars to buy yen. So the price of a Toyota in the U.S. comes down, which of course would cause the imports to increase into the U.S. If the dollar is weaker against other currencies, however, now it takes more dollars, let's say, to buy foreign currency, to buy a euro or yen or pounds or pesos or whatever it might be. So therefore, the price of of U.S. goods is now looking actually more attractive, right? Because it takes less of their money to buy a Ford or a Cadillac. So exports will increase if the dollar is weaker, because now the price of a Ford or a Cadillac in another country, right, is less expensive now. So it makes it more desirable, it makes it more affordable. On the same time, U.S. imports will decrease because now it takes more U.S. dollars to buy a Toyota, okay, or a BMW, and so the price of Toyotas and BMWs will increase in the United States, making them less appealable, right, and less likely to want to buy them. Okay. In fact, when we look at our trade, let me see if it's on the next slide. I don't think it is. No, it's not. So let me go his. Okay. So whatever is good, it's basically this: whatever is good for a country's economy is good for its currency. So if if the U.S. economy is expanding, then the dollar becomes stronger. If the Canadian economy is expanding, then the Canadian dollar becomes stronger. So whatever is good for a country's economy is good for its currency. All right, with that, we're at the quarter to the top of the hour, so this is the time I'm supposed to let you out the door. Okay, so we'll finish everything up come on Wednesday. Okay, so until then, tune in Wednesday. Same bat time, same bat channel. Okay, we'll see you again, everyone, on Wednesday evening. Now I've had the chance, by the way, to go in and check out some of your, see how you're doing on your quizzes and stuff. And you might notice that you've seen some more points added recently. So, for those, some of you maybe if you're doing okay, some maybe are kind of behind on that. So you want to. This is the time to start getting caught up. So keep taking your practice exams, and get to mastery exam 2s, mastery exam 3s, right? And again, if you take you can take quizzes and questions more than once. Remember, I'll always consider your highest score, just with a chance to get more practice. The more you do it, the better you get at it. Okay, and the better you'll do on the actual test. We'll see you again, everyone. Take care. Have a great day. Bye bye.